Welcome to The Explainer. Right now, we're watching one of the wildest standoffs in the entire market. On one side, you've got Palantir stock, ticker PLTR, literally skyrocketing to $175. But on the exact opposite side, you have Michael Burry, the legendary big short investor. Well, he is aggressively betting on a massive, historic crash for the company. We're basically watching the AI hype train collide head-on with a classic fundamentals-driven short thesis. So what does this all mean? Is Palantir a genuine AI rocket ship, or are we just looking at a hyperinflated tech bubble? To actually answer this, we need to strip away the noise and objectively look at the real-time data driving both sides of this massive financial tug-of-war. We aren't here for opinions. We are diving into the hard numbers, the charts, and seeing where the big money is actually placing its bets right now.
All right, section 1, the bull case. Let's look at exactly why PLTR is soaring right now.
You really can't deny the momentum here. Palantir's Q2 revenue recently hit a staggering $1.94 billion. That's up 93% year over year. But the number that absolutely steals the show is this 149% growth specifically in their US commercial revenue. For years, Palantir was seen as just this super secretive government contractor, right? But this 149% explosion on the commercial side, it's a huge neon sign signaling undeniable enterprise AI demand. Companies aren't just testing Palantir software anymore. They are aggressively buying it. And here's the kicker. They're doing it profitably. Just look at these metrics. Operating margin is sitting at a highly profitable 62%. But take a second to look at that Rule of 40 score. It's at 155%. Just to put that into perspective, in the software world, if your growth rate plus your profit margin equals 40%, you're considered a top-tier business. So 155%? That is practically off the charts. It's exactly why analysts at Bank of America and Mizuho are throwing out price targets of $255 and $215. For a lot of institutions, Palantir is the absolute purest AI play in the public markets right now. But on to section 2, the bear case. Here is why Michael Burry is convinced this is a massive bubble. The guy who literally called the 2008 housing collapse? Yeah, he's not buying the hype. Instead, he's loading up on put options, basically betting the stock will fall, with strike prices hovering way down in the $100 range for March 2027. His whole thesis comes down to valuation. At 150 times earnings, there is absolutely zero room for error. And when a stock trades at 68 times sales, the market is pricing in flawless execution for years to come. Combine that crazy valuation with massive stock dilution risks for everyday shareholders, and then noticeable slowdown in their legacy government contracts, and man, you've got a recipe for a severe correction if they miss even one quarterly expectation. And honestly, this comparison right here brilliantly illustrates the sheer scale of the valuation we're dealing with. Palantir's market cap has swelled to over $420 billion. That means this single software company is currently worth more than Boeing, Lockheed Martin, and Northrop Grumman combined. That's 3 of the absolute largest aerospace and defense titans in the world. For the bears out there, this is the ultimate red flag that the stock has completely detached from reality. Because Burry believes this commercial explosion is already perfectly priced in for the next 10 years, his bearish bet suggests a catastrophic drop to under $1 per share on a pure intrinsic value basis. Basically, he's saying that the second this AI euphoria fades, the underlying fundamentals simply cannot support this massive $420 billion structure. If that happens, the floor could just completely fall out. Okay, moving to section 3, technical analysis. Let's step away from the opinions for a minute and look at what the chart says is actually happening. Because look, narratives tell us what should happen, but price action tells us what is happening. And right now, the chart is telling a wild story of extreme momentum mixed with some very serious flashing warning signs. On the bullish side, the stock just broke out of a multi-month symmetrical triangle pattern, which strongly points toward upside targets of $183 and eventually the $196 to $207 range. But hold on, the warnings are glaring. The RSI is sitting over 74. That's firmly in overbought territory. Plus, the stock is stretched 20% above its 20-day moving average. Historically speaking, when a stock rubber bands this far from its average, it almost always leads to a sharp, sudden pullback. Which naturally brings us to the key support levels. If you're itching to buy, the much smarter play might be waiting for a dip into these key zones, especially the 159 to 166 range, rather than just chasing it at the absolute top. 171 is the first floor, but if that breaks, well, 159 is exactly where we'd expect the serious buyers to step back in.
Let's see how this builds into the derivative space, specifically looking at the volatility risk premium, or VRP. Right now, it's actually negative. That tells us there's zero fear priced in and literally no cushion for sellers. Basically, the stock is swinging harder and faster than the options market even predicted. When VRP goes negative like this, it means the market has gotten way too complacent. Everyone just assumes the stock will keep gliding up smoothly, which, as any experienced trader knows, is exactly the kind of environment that breeds unexpected turbulence.
So, Section 4, the options market. Let's track where the big money is actually placing its bets. We know what the analysts think, and we know Michael Burry's thesis, but options flow shows us the real-time movement of institutional cash. And when you look at it, Burry's $9 million in puts, it's actually a pretty small hedge relative to the massive size of his portfolio. He's buying long-term insurance, not necessarily betting his entire fund on a crash tomorrow. Meanwhile, short-term traders are going wild. Overall market call volume has spiked heavily, with traders aggressively piling into the $180 and $200 call strikes, betting this momentum will just easily carry the stock higher in the coming weeks. With the put-call ratio heavily tilted bullish, traders expect volatility to stay high, sure, but they expect the immediate trend to remain up. They know full well that a 68 times sales multiple is incredibly rich, but honestly, they don't care. In a momentum-driven market, logic takes a backseat to capital flow, and right now, that capital is flowing powerfully, and it's flowing upwards. All right, Section 5, your action plan. Let's talk about how to actually navigate this PLTR tug of war. We've synthesized the bull case, the bear case, the charts, and the options. So how do you actually play this? It completely depends on your time horizon. In the short term, like the next 6 to 18 months, a run to $200 or beyond is absolutely possible, purely driven by earnings growth and their perceived dominance in AI. The bulls are totally in the driver's seat today. But looking out 3 to 5 years, any stumble, whether it's budget cuts, a slowing economy, or fierce AI competition, could trigger a violent re-rating. When a stock is priced for perfection, imperfect news hits exponentially harder. So you've got to tailor your strategy to your view. If you're a bull, patience is your best friend right now. Wait for a dip into that 159 to 166 range and use tight stop losses. If you're a bear, whatever you do, don't short this crazy momentum blindly. Use 6 to 12-month out-of-the-money puts as insurance, kind of like what Burry is doing. And if you're neutral, keep your eyes glued to that critical 171 level. If it breaks down, a larger correction is starting, but if it pushes above 183, the rocket ship is still ascending. Regardless of which camp you fall into, please remember this. Palantir has a beta of 1.56. That means it moves incredibly fast, experiencing swings about 56% more violent than the broader market. This is the definition of a high-conviction, high-risk stock that requires strict discipline. Never bet more than you can comfortably afford to lose, because with PLTR, volatility is basically guaranteed. We've laid out all the data for you in this explainer, from breathtaking revenue growth to dizzying valuations. So I leave you with this final thought to consider for your own portfolio. Looking at everything we just covered, are you buying the AI rocket ship, shorting it for reality check, or just safely watching the fireworks from the sidelines?